Okay, this is an example for Chapter 11. We're going to be here using a worksheet that's posted on As You Learn, and this worksheet's going to cover the mechanics of actually forecasting the income statement and the balance sheet for a firm. Now there's two tabs here in this example. There's the solution with everything already filled out and explained, and you can click through and see all the formulas that are being used here. And then there's an attempt here, which is empty, and we're going to calculate the attempt. And what I'd like you to do at home, and what I encourage you to do, is to try and do the attempt based on the lectures, based on the slides. See if you can get the same numbers in the forecasts and the forecast ratios as I do in the solution. If you can do this, then you're going to be well prepared for the homework, because this is exactly what the homework is asking you to do. Remember, homeworks 4 and 5 are combination of problems where you're going to be doing a DCF for a made-up firm. And homework 4 is where you forecast the income statement and balance sheet. And so you're going to be doing the same thing here in a bigger way in the homework. So make sure that you can do it here. Make sure this is where you can check your work, and that way you're prepared when you go to the homework problem. Okay, so what we're trying to do here is forecast the income statement, and here we got a simple income statement: revenue minus cost of goods sold minus selling and general expenses, administrative expenses, depreciation gives me operating profit, EBITDA. We got interest expense, interest income, non-operating income, that gives me earnings before taxes. We got income taxes and net income. Then we reconcile reported taxes so that we can calculate operating taxes. Remember, we're doing this in anticipation of reorganizing the balance sheet, calculating NOPLAT, which requires an operating tax rate and operating taxes. But we'll reconcile that with the income statement so that we see that reported taxes and can still be calculated based on our operating tax measure. Then we'll forecast the balance sheet, looking to make sure that all the balance sheet items grow at the appropriate rates in our forecasted year. And then we'll forecast the statement of retained earnings and make sure that the income statement correctly reconciles and flows into the balance sheet, specifically into retained earnings. Remember, the whole thing is a big interlinked wheel, and we have to make sure that all of the individual forecasts that we make don't drive any inconsistencies in the accounting statements. And this is actually, it's really easy to do. Even if you're paying attention, there's so many items, there's so many things. You make a forecast that affects revenue differently and then you make a forecast that incorrectly forecasts depreciation, which drives off net PP&E, and you end up with a balance sheet that's out of whack. So you just got to be careful that all of this reconciles really well, and that's why we're going to do all of these. And again, you'll do the same thing here in your homework. So we start with the most important forecast, and you'll notice that the most important forecast is already filled in, and it's not the result of a calculation. We spend quite a bit of time talking in the lecture about forecasting revenues, and this is basically the most important forecast that you'll do in your entire analysis. And you're going to forecast revenue, in a number of different ways, using a number of different ideas, and you have to try your best to get this as close on the money as we can. Now, revenue is one of those forecasts that is likely to change over time. For instance, 20% revenue growth might be a reasonable forecast if the firm was planning on introducing a new product or some kind of investment push was going on. But 20% revenue growth in a long term over a 10-year forecast, totally unreasonable. And so we would expect that revenue growth to shrink over time if we were doing a long-term forecast here. Whereas the other forecast, unless we are specifically forecasting that the firm is trying to change one of these items or trying to change the way they operate with regards to one of these items on the income statement or balance sheet, the rest of the forecasts are pretty likely to stay the same in a long-term forecast. So for instance, unless the firm was engaged in a cost reduction strategy, say hoping to reduce cost of goods sold as a percentage of revenue over the long term, and their plan of attack going forward is not to increase revenue, rather to decrease costs, then we might see a change in the cost of goods sold as a percentage of revenue going forward. Otherwise, we would expect the rest of our forecast to stay the same over time. And that's what you should expect to see in the homework as well. So we've forecasted revenue here 20% in 2015. I've already calculated my revenue growth here. This is just revenue in 2014 times 1 plus the growth rate in 2015. This is your standard growth rate formula. And that gives me growth of 20%. So 240 to 288 in 2015. Now we need to forecast how all the rest of these items change. And we're going to do that in 3 steps. The first and most important step I already did for you. And that is when we're forecasting an item on the income statement or balance sheet, the most important thing that we need to start with is what drives this item. Right? So we're looking at cost of goods sold, and I'm trying to understand if I want to forecast how cost of goods sold changes from 2014 to 2015, what is the main thing that's going to drive cost of goods sold going forward? Right? Remember, cost of goods sold, this is all our variable costs associated with producing whatever we're producing. So this is all our costs associated with producing, let's say we're making bikes. All the costs associated with producing bikes. So what's the most important driver of the costs associated with producing bikes? Well, it's the revenues that I generate. Because if I have higher revenue, that means I have higher sales numbers. And if I'm selling more, I'm going to have more cost of goods sold. Right? My variable costs are going to go up at a minimum. My fixed costs might even change at certain levels. Okay? So my cost of goods sold is definitely going to vary with revenue, and that's the first and most important part of a forecast model. Each item, we need to sit there and say, what is going to drive the item? So here, cost of goods sold is going to be driven by revenue. So my best prediction is the historical relationship between cost of goods sold and revenue. So I want to say, I think as a percentage of revenue, cost of goods sold will stay the same. Now notice that that's here a negative. I really don't like to display it as a negative. So I'm going to take the absolute value of each of these. That's because I like my revenue forecast numbers to be positive ratios. And even though I'm going to display here, keeping accounting convention, keeping as a negative. So when I write my actual forecast number, we'll have to reverse this absolute value function. So let's finish the top of the income statement, then we'll come over here and we'll forecast these. So SG&A, this is selling and general administrative expenses. So this is employee labor costs, this is your other fixed costs, anything associated with selling or any other administration expenses. So again, my employee cost, my other labor costs, my selling costs, all of these things are going to be a function of revenue. The more I sell, the more employees I need. The bigger the company is, the more accounting, other administrative functions I need. The more employees I have, the more housekeeping labor I'll need. The bigger buildings I'll need, the higher my utilities costs are all going to be. So this is, again, it's going to be tied as a function of revenue. And so again, we'll look at, this is a cost, so I want the absolute value here of SG&A expense as a function of revenue. And we'll see that cost of goods sold is a 37.5% historically of revenue. SG&A is 18.8% of revenue going forward. Now, depreciation is going to be a function of not of revenue here, and this is an important thing to note, because depreciation is what we do to our fixed assets. Right? So depreciation is going to be a function of how many fixed assets we have and how we're depreciating them over time. And so my depreciation expense is driven by my fixed asset expense. And in the lectures, we're going to talk about some important distinctions here as well. This isn't as simple often as we make it out, but this may be the best way to do it. So we'll take the absolute value here of my depreciation expense as a function of, and notice here the subtext is important. This is depreciation expense in year T divided by net PP&E in year T minus 1. Now this is because I'm depreciating assets, fixed assets that I already own. So it's inappropriate to divide to look at the depreciation expense in 2014 as a function of net assets in 2014, because that's not how I'm calculating depreciation expense. I'm calculating depreciation expense based on last year's fixed assets. Right? And so that means my forecast for 2015 will rely on 2014's fixed assets, and we had an increase in fixed assets, so I'm going to have more depreciation. And then finally, my EBITDA, my operating profit as a percentage of revenue, and we will see that operating profit as a percentage of revenue is 35.8%. Right? And so this is what we expect the top line. This is our forecast for the top of the income statement. And how we calculate that, right? And we change this from percentage to value. What we say is, if I want my 2015 cost of goods sold to be 37% of my revenue in 2015, then I need to take this revenue times my forecast ratio, 37.5, and then I want this to display in accounting format. Right? So I'd say, okay, $108 is 37.5% of 288 in revenue. So this is my cost, but because I want it as a cost and because I want to display it in accounting format here as a negative, I'm going to multiply it by -1 to change this to a negative. And then I'm going to come over here and I'm going to change all of these to accounting format. So I'll go up to the top, I'll change it to accounting format, and then I will get rid of the and I'll change all these to accounting format. That way the negatives are in parentheses, which is standard accounting format. And then I do the rest, the same thing for everything. So I multiply the driver, whatever the driver of the line item is, times the forecast ratio for that line item. So for SG&A, I want SG&A to be 18.8% of forecasted revenue. It's going to be a negative, so I want to multiply it by -1. Depreciation, right? I want depreciation to be not a function of 2015 revenue, but instead a function of 2014's fixed assets, net PP&E. Because that's what I'm going to be depreciating into 2015. And we can see here that our EBITDA, which we have as a function of revenue, grows to 103.2%, $103.20. Notice that this should also be the result. Now here we come to our first issue, right? And something that I want to make really clear, and it illustrates what I was talking about right at the beginning, which is that we have to make sure that our income statement and our balance sheet reconcile correctly, right? So one of the things I don't want to do is what I did here, which is forecast a summation line item. One of these line items here that's the result of the line items above it. So I don't want to forecast EBITDA directly, because notice what happens. I am pretty close to the actual number, which is here, right? The actual number is the sum of revenue minus my cost minus my depreciation, and I'm pretty close here, but I'm driven off because depreciation is not a function of revenue, it's a function of net PP&E. And net PP&E can grow at a rate that is different than the growth rate in revenue. In fact, it has grown at a rate that's different than the growth rate in revenue. It's grown at a 25% rate, and revenue has grown at only a 20% rate. And so that's driving a difference in my depreciation, which means that as a function of revenue, EBITDA is going to be slightly smaller than last year. Right? So I have to be really careful here. I'm never going to forecast these resulting line items. Only forecast the inputs, never the results. Okay? So I'll delete this. I'll come back and I'll do this correctly. I'll take the sum of the items here. I get 102.25. And then just to show you, I'll change this as a function so that it's a function of the correct items. And we'll see that our operating profit as a percentage of revenue went down slightly because our depreciation as a function of net PP&E went up a little faster than revenue. Okay? So this is one of the things we got to be careful for.